And what we really need to do is to understand the firm. If we don't understand the firm, we are not going to do a good job. We really need to know what is the firm about, I mean the goal of the firm, where the firm operates, and the strategy of this firm, okay? Then we have to identify the accounting issues, and this is going to be super related to this part. To understand the accounting, we really need to know where the firm operates. We can have the same firm operating in the States or operating in Australia, exactly the same goals, the same strategy, the same type of operations, and accounting numbers will tell me something different only because of different regulation. And we really need to understand as well accounting choices. And this is going to be related with earnings management. We really need to know the incentives. We really need to know the firm to understand why these accounting numbers instead of others. If I pay my executives based on, for example, stock options, the accounting numbers are going to be different than if I pay them only with a fixed salary. Depending on the incentives, the accounting numbers are going to be different. And to understand and interpret these accounting numbers, you have to know that. So this is like the basic level of financial statement analysis. The first step. The things that you always have to ask yourself. So, where the firm operates. The situation of the firm. If you want to beat your enemy, you have to know your enemy. If you want to analyze a firm, you have to know the firm. It's not the same, for example, to analyze a firm of your local country or to analyze a firm that is a foreign firm. Why? Because you know much more about regulation of your own country than in a foreign country, unless you are an expert on this other country. So we really need to know what is the competitive position of the company. It's not the same to be the leader of the industry than one small company that only operates in a neighborhood. It's not the same to analyze a big company with a lot of market pressure than a small company that basically operates to have money to feed their family. It's not the same. The incentives are totally different. So the first step is just to analyze the firm at qualitative level. Before going to the financial statements, you have to know the firm. Before even go to the balance sheet and income statement. In order to understand these two statements, you really need to know the firm. And then you are much more prepared to analyze this firm. So what I'm meaning for qualitative information in this case, I really need to know the industry. I really need to know the strategic analysis. And I really need to know where the firm operates. It's not the same to be in the health insurance industry than in, for example, customers or like coal industry, wash farmers, and so on. The regulation is even different. For example, you may know that banks and and insurance companies have a totally different accounting system. They follow accounting rules. They do. But apart from that, they have to fit and comply with all specific regulation in the industry. In banking, they have a lot of regulation. They have to meet some ratios according to Basel, now Basel IV. They have to comply with the accounting regulation and industry regulation. So obviously, these accounting numbers are going to be totally different than those accounting numbers in another industry, where they don't have to meet this regulation. Is it clear for everyone? This is important because I don't know why, when especially in the final, when I just show you the case study, you forget about this part. You just start calculating ratios and ratios and ratios, and you get crazy with that, without taking into account that the first step is to analyze the firm, where this firm operates. This is the starting point. First, you have to know it, and then you will analyze it. Okay? So let's start with geographic analysis. Where the firm operates. It seems quite a simple question. It seems. However, the regulation here is quite tricky, and I will explain you why. So what we want to know, if the firm is diversified, for example, there is one firm that only operates in the US, and there is one firm that operates in the US and Australia. What happened during the global financial crisis? Which one is going to be less affected? The one that operates in Australia as well. Why? Because in Australia, the crisis was not so heavy. So the one that only was operating in the US is going to be more affected, provided that they are operating in the same industry and blah, 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 everything else equal, okay? Than the firm that operates as well in Australia. What are the country risk factors? It's not the same to operate in Australia than in Afghanistan or in Syria. It's quite obvious. And if we don't know that, if we don't know that this firm operates in high-risk countries, we will be underestimating some accounting numbers. We really need to know where the firm operates. However, we have a problem. I will show you first the problem with different regulation. This is a Hitachi firm that shows two accounting numbers, okay, under IFRS and under US GAAP. I think that this is quite visual because we are talking exactly about the same firm, same year, same. The only difference is the regulation. And we have here that this firm operates in Japan. Sorry, I should just just switch off this screen. I'm really sorry, but the chair is broken, and I asked a new one, but it seems that there is no chair. Don't ask me why. So it seems that this company operates in Japan. That is the local one. Hitachi is a Japanese company. And also operates in Asia. I understand that the rest of Asia North America, Europe, other areas. Okay. These are the numbers under IFRS. These are the numbers under US GAAP. For example, take March 2014, revenues in Japan, 5,310. Okay? Here is 5,303. It seems quite a small difference, but we are talking about millions of dollars. So it's a huge difference. Exactly the same firm, exactly the same year. The only thing that is different is the accounting regulation. So now remember the question when you are going to analyze some accounting statements. Where is this firm operating? And what is the regulation that this firm has to follow? Because it's not the same to follow IFRS or US GAAP. The problem now is that we cannot compare this anymore because this comparison is not compulsory anymore. So now, if they provide these two numbers, it's because they want to provide more disclosure. But just one firm, different regulation, different numbers. So you can appreciate that knowing where the firm operates is important. Then we are going to talk about this example that for me is really funny. It's General Motors. Well, the information is quite scarce. Why? Because this firm is saying that they are operating in the US and in other countries that are non-US. Okay. A lot of information. I have no idea what non-US countries mean. It could be Europe, it could be Africa, it could be South America. So basically they are not telling me a lot of information. The problem with this regulation, as you may appreciate here, is that there are no rules. Nor under US GAAP, neither under IFRS. They have to provide information on assets and sales of segments that they disclose, and by segments I mean countries that they disclose, but they don't have to disclose the profit. And there is nothing about the aggregation of the foreign countries. So they could say US, non-US, Europe, North America. Well, in Asia it's not the same to invest in one country than in another, as well as in Europe, as well as in North America. So this information is not very precise, it's not very comprehensive. And the problem is that there is no regulation. Where the profit comes from? Here you have a lot of information. It's one of the most detailed firms that I was able to find. It gives you a lot of information on segments, I mean countries, because it says that operates in Japan. Well, this is not very useful because Komatsu is a Japanese firm, but it says that operates in North America, Europe, Latin America, CIS, China, Asia, Oceania, and so on and so forth. But only talks about sales, not profit. Why this is important? Because I could be selling under cost, or I could be selling over cost. Why, if I'm investing or operating in tax havens, the incentive is going to be different than if I operate in a high tax country. So sales are not saying anything I want to know about the profit. And if possible, I want to know in North America in which states, in Europe in which states. There is a huge variation between countries within a continent. Okay? So this is the problem of geographic analysis. So it seems simple. I just say you have to know the company. You have to know where this company operates, which countries, which industries, and blah, blah, blah. But this is not easy to know. And the main reason is because if I'm operating in a high-risk country, I will have a huge incentive to hide this information. Or if I want to have a competitive advantage in one country, and I don't want my competitor knowing this information, because I will make much more profit if I hide this information, I will have a lot of incentives to hide this information as well. However, the regulation in this regard is quite scarce. It would be ideal to know exactly in which countries operates the company, but this is the ideal world. The reality is that regulation does not ask huge information in this matter. More or less the same happens with the industry analysis. Okay? I really need to know the industry evolution, what is my competitive advantage within the industry, my bargaining power, not only with buyers but suppliers. Because when I'm interpreting the ratios, it's not the same to be the leader of the industry than the follower. Okay? And the strategic analysis. I want to grow in the next couple of years, because if I want to grow, I will be investing in PPEs. If I don't, I will not. This is a huge difference as well. However, this is quite sensitive information. Why? Because if I talk about my strategic analysis, competitors will know everything about my plant. So I have a huge incentive to hide this information. For example, there is a regulation in the States that talk about, well, for example, if you work for Coca-Cola, you cannot talk about the formula of Coca-Cola outside the firm. And if you do, you can be sued because of that. So there is like this regulation in order to prevent the competitors knowing about my competitive advantage. However, how can you control all of this? It's almost impossible. Because if I was working for Coca-Cola, it's going to be high likely that if I quit this job, I will go to Pepsi. And even don't do it intentionally, my know-how is going to be the one that I learned in Coca-Cola. So it's almost impossible, even with these kind of regulations, to prevent competitors knowing more about me. Okay? So we really need to know where the firm operates, not only the country, but also the industry. What is the strategic of the firm, the future plans for the next couple of years, and with that, we can start to analyze accounting numbers. Okay? For example, if I'm operating in a huge amount of tax havens is quite likely. I cannot never say it's 100% sure, because I cannot say that anything is 100% sure in finance or economics or accounting, that I have a huge incentive to avoid taxes. So if I know that the incentive is to avoid taxes, I will look for some red flags and not others. Okay? For example, if the executives are remunerated with stock options, I will look for some red flags that does not apply to those that, for example, are remunerated with a fixed salary. Knowing the incentives is crucial. Okay? So there are three factors affecting to the quality of information. One is accounting rules. It's not the same to follow IFRS and US GAAP than local GAAP. This is to begin with. The second is how you apply these rules is different, and it depends on the governance of the firm and the enforcement of the country. For example, if you don't apply a rule properly in Spain, it's like, oh, okay, next time. Try to do that in Germany. Then you will have a huge amount of money in fines. For example, here in South Australia, the rules are much more strict, for example, in Victoria, than in the Northern Territory. In fact, if you see some companies, especially councils in the Northern Territory, most of them, 80% of them, have a modified opinion in their audit reports. So obviously, this is a signal that something is not very well, and the enforcement is not the same. Like in Victoria, that I think that in the last 5 or 6 years, there is only one, and was a special case for something minor. So even within a country, you can observe a huge difference. The estimation errors. Why? Because most of the accounting numbers are based on estimates, and estimations can or cannot be accurate. And what about the information, the forecast information that I have to give about my company? This is a prediction, an estimation. It could be done with all my good fight, but maybe I'm doing it wrong. I mean, nothing to hide, but still wrong. And then the accounting choices that most of them are quite intentional. And if you see the three of them are mainly consequences of incentives. So if you want to interpret correctly financial statements, you need to understand the incentives of the one preparing the financial statements. Okay? So you have to understand accounting regulation, okay? But what is much more important, you have to understand the interpretation of the manager who did these financial statements. One sentence can be interpreted in different ways by any of us that we are in this room. How do I know how your interpretation differs of my interpretation? Cultural background, priorities, your priors, your incentives. The same with firms. Okay? So basically, I have a lot of incentives when preparing my financial statements, and basically it's because the capital market pressure. For example, I'm Google. I'm in the market, and next year's, well, in 2019, investors are expecting that I have 50 in earnings per share. Do you think that I have incentive to say that I got 49.5, even it was true? No, because if I say that, I will be strongly penalized by the market. I will have more incentive to say, no, well, I did 50. For example, if analysts say that Google will be 51, this is going to be the expectation of the market. If I don't meet this expectation, I will be penalized by the market. So again, what is my incentive for preparing the financial statement? At least meeting the expectations, not to be penalized. But I have this problem only with firms that operate in the market. So first thing to know is the firm operating in the market or not? Because if not, I will not have this pressure. Okay? Debt contracts. For example, if I have a contract that have a covenant saying if you pay more than 10% of dividends, I will increase the cost of debt by 1%. Do you think that the firm is going to pay 11% in dividends? No, no way. So this is something that I have to know in order to understand accounting numbers as well. Compensation, this is crucial. Compensation of the managers. The managers are doing accounting numbers. How do our compensating is crucial. It's not the same saying you will get $1 million regardless what you do, or you will get 100,000 plus 90% of stock options. It's not the same. Political cost, regulatory cost. It's not the same breaking rules in Northern Territory than in Victoria. And firms know that. And they choose the state where they want to operate because of that. Apart from taxes, apart from any other thing. But local regulation is important. The more strict the regulation is, the more rules that you have to apply and comply. And this may or may not be good because you will have less flexibility, let's say in that way. However, if you choose the higher enforcement level state, you will have more credibility. Okay? So it's a balance. It's a decision you have to choose. But the problem is that you really need to know these decisions in order to interpret accounting numbers and taxes. Well, maybe these ladies in the front know more than me, but one of the main focus of Italians are paying less taxes as possible. Here, in Italy, in Australia, everywhere. So if you want to do a good tax return, go to an Italian guy. And everyone knows that. So it's like one of the main goals of them. Knowing this information will help you to interpret better the accounting numbers. Okay? So here is an example. Google. October 2012, the consensus of EPS was EPS is earnings per share, was 10.65. However, they were not very able to make it, and they disclosed that the earnings per share was 9, while below analyst expectations. This is the share price. What happened? Drop it dramatically. Only one day. What happened? Anything else than not meeting expectations. So there is a huge amount of incentives of meeting or beating the expectations. And if you see here the volume, oops, there were a lot of people trading that day, basically selling the stocks. Okay? So yeah, the information is crucial, and incentives are really crucial in order to understand accounting numbers. Okay? So basically, I have to identify the accounting policies, and these accounting policies are going to be based on the industry, strategic analysis, and geographic analysis. So it's because I said this is the first step. You really need to know where the firm operates, I mean, not only the countries, but also the industries, and what is the future plan of the company. Well, assess the accounting flexibility, evaluate the strategy, and for that, I have to compare with peers and prior years. If I'm doing something that is quite unusual in my industry, this is quite suspicious. If suddenly I'm doing something very differently from prior years, this is quite suspicious. So I have to identify these red flags, okay? Evaluate the quality of disclosure, if there is any quality, and then I will be able to identify the red flags. If I'm quite obscure in one note, or just copy and paste regulation, and not providing any type of information, it's quite likely that there I'm hiding something, which may or may be not wrong. Maybe the only reason because I'm doing that is because of the competition, just not to give some hints to my competitors, not because I'm trying to manipulate anything, okay? I'm not saying that earnings management is always bad. For example, if I'm doing something very unusual this year and I don't provide any explanation, then I have to ask myself why, because this is going to determine my analysis of the company. If I change a lot my, for example, earnings, suddenly instead of earning 10,000 and I earn 100,000, my earnings per share is going to change. But why this change? Because maybe it changed because I grow, and obviously I'm earning much more because I invested much more. And there's nothing wrong with that. Or because this year I would like to exercise my stock options or something like this. So I will provide a higher number to the market, so stocks are going to go up, and then I will exercise. Okay? So we really need to understand why firm did or made these decisions. And once you identify the red flags, you have to go one step back, saying, what if this company, instead of doing this year, will follow exactly the same trajectory as last year? How these accounting numbers will look like? And then you will have the difference to quantify the potential distortion of accounting numbers. Okay? So there are a lot of red flags. So basically, you have here some of them, but not all of them. You have to look for something unusual. And to look for something unusual, you have to do comparisons. Comparisons between what and what? Between my firm and peers, my firm in T and my firm in T minus 1, T minus 2, T minus 3, and so on. The problem is, what are peers? This is quite tricky. Sometimes I'm not very similar to my industry mates. Sometimes I have much more similarities with a foreigner. So this is a tricky question. To identify the comparison group of my firm is quite difficult. So let's talk about earnings management. The methods, the concept, and the reasons. And if possible, if there is a constraint or not. So what it is? At a very broad level, it's the process of manipulating financial statement numbers, doing adjustments, real activities, or both. Basically, doing distortions in accounting numbers. And again, I'm not selling only the bad side of earnings management. I could do it in a good fight, with a good purpose, okay? Earnings management are not always bad. Which, I'm not saying with that you should do that, okay? I'm not encouraging you to do earnings management, but you have to understand that sometimes when analyzing a company, some earnings management are doing in order to provide even more information to investors, okay? So, good or bad is a tricky question. So basically, the goal of doing that is because I want to obtain some gain, okay? Why? If I'm increasing earnings intentionally, it's because I will get more remuneration, for example. So why I'm doing that? Because I will obtain some gain, not because of nothing. And the thing is that this earnings management is done in order to mislead some stakeholders. I'm not telling the truth to my investors, and I'm influencing the contract outcome depending on reported accounting numbers. For example, if I have a loan, if I manipulate the accounting numbers in order not to violate a covenant, I'm influencing that with this purpose, okay? So basically, earnings management is manipulating accounting numbers. So I have to identify where the accounting numbers were manipulated and go back one step in order to analyze the firm correctly, okay? Okay, there are two types of earnings management. One is the accounting choice, and the other one is real earnings management. Accounting choice is basically if I overvalue R&D, if, for example, I'm selling a lot of items but not getting any money and having it on credit, so I will have a lot of accruals there. And real activities manipulation is much more real. I mean, I'm just delaying sales, which is nothing to do with accounting policies. Accounting policies are much more, earnings management based on accounting policies are much more based on accruals, okay? While the others is like I'm just cutting R&Ds, selling instead of next year in a couple of years more, just to delay the process. And there is one more thing that is not earnings management. And we have to distinguish between these two very well. It calls fraud. It's illegal. I could manipulate accounting numbers within the law, but once I break the law, this is illegal and this is fraud. For example, recording fictitious sales. It's nothing to do with accruals. I'm just saying that I sold something that I didn't. This is illegal. This is fraud. And this is one of the most fraud cases. If you, for example, look at the US in the last 20 years, 80% of fraud cases were recording fake sales and backdating sales invoice. What is the reason of backdating sales invoices? I sell, well, let's start. My fiscal year ends at 31 of December, okay? And I sell something on 2nd of January. I recognize in my books because I put, well, they are open yet, so I recognize in my books by 30 of December. This is illegal. And 80% of the cases of fraud are based in these two cases. I recognize sales that are fake, and I recognize sales when they didn't occur. Okay? What are the methods? Within GAAP, outside GAAP. Within the law, outside the law. So, earnings management, fraud. So there are accounting adjustments. Basically, you have to look for the accruals. You have to look for how different the income statement is from cash flow statement, because this is a quite direct way to identify the red flags and real activities. However, real activities are quite hard to detect, because why firm cut down R&Ds? Maybe it's another reason than earnings manipulation. Maybe it's a lack of cash, or maybe because they don't want to invest more in the company in that way. And then outside GAAP, okay? And you will remember cases like Enron or WorldScope and this kind, Volkswagen, okay? There are quite, well, standard patterns of doing earnings management. Here are the 4 that are the most common ones. Big bad. Well, my income statement is bad, but I will make it even worse. Why? Because next year, earnings will increase much more than expected. I know that the investors know that the firm is going to be bad, so I will let them know that was even worse. So then, even next year I will gain $1, is going to be good news. Big bad. Income minimization, for example, to pay less taxes. Income maximization, to get more remuneration. If you see, I'm just talking about earnings management pattern and a potential incentive. Without knowing the potential incentive, I will not know the pattern. And income smoothing. This is super common. If you see the earnings of a firm, you will not observe a huge volatility of these earnings numbers. And this may or may not be bad. It's easier to predict, less risk, which means less cost of capital, less cost of debt, more information for shareholders. Okay? So again, accounting adjustments are change in accounting policy, I was depreciating my assets 5 years, now I decide to change to 10. Obviously, my earnings is going to change. Okay? Adjustments in accruals. These have no effect at all on cash flows, and real activities, basically operating, investing, or financing, and they have a huge amount of impact on the cash flows. Okay? So, for example, a change in accounting policy, change in depreciation methods, and there are a lot of examples. For example, the Warren Telecom change from 15 years to 20 years. They have to give a good reason for doing that, but still they do. And there are adjustments in accruals, for example, revenue recognition. When I recognize the revenue, it's going to be in T, T minus 1, T plus 2. And there are a lot of earnings management models that take into account that. If I sell something, I should have my money between the range of T minus 1 and T plus 1. If not, it's because I'm doing these kind of things strategically in order to manipulate the accounting numbers. For example, doing the wrong classification, shifting, for example, operating costs and to non-operating costs, because the main focus is in operating income. And the real earnings management is, as I said, cutting R&D or prepaying debt or boosting income through assets or security sales. However, this is quite hard to detect because the reason of cutting R&D, it could be because I don't have money this year, not because any other reason. This type of earnings management is much more difficult to detect. This is the first thing. And second, is much worse for the company than accruals management. I'm just referring to the accruals management to accounting earnings management. In other words, it's accruals management. Okay? This is bad, but not as bad as real activity manipulation. Because if I'm spending less in R&D, this is going to be really bad for the company. If I'm selling my assets, this is going to be even worse for the company. Okay? Very hard to detect. The motives, or in other words, incentives, are contractual, compensation, and debt contracts. The problem with debt contracts is that more often than not, this information is not available in the financial statements. However, compensation, by law, they have to talk about this in a note in the financial statements. Regulatory is just to avoid regulation or to, for example, to apply for grants. I invite the CFO of a non-for-profit organization, still have to confirm, but, well, they have a lot of pressure on receiving grants. Without grants, a non-for-profit organization will disappear. Okay? So there is a huge incentive there. And before forgetting, yes, that I talk about that, the 22nd of August, two people of PricewaterhouseCoopers will come to talk about the cash flow analysis from real cases that they were auditing. Okay? I will put an announcement much more close to the date, but just before forgetting. And then the capital market. As I say, the analysts, they have a lot of pressure. Investor expectations, if I don't meet the expectations, then it's going to be quite hard because I will be penalized by the market. So I have a huge incentive not to be penalized by the market, because if I'm penalized by the market, my stock options will be costless, for example. Okay? So basically, there is not going to be one or the other. It's going to be the three of them together. You have to balance which one weighs more in order to detect these red flags, okay? So there are some examples here about IPOs, insider trading, earnings announcements, if I meet or not the analyst forecast. So you have here a huge amount of examples on when it's more likely to engage in earnings management. Something that has been detected in accounting research, okay? So here you have some numbers. It's much better to meet expectations or exceed by 0.01 than not meeting the expectations. And you have here the frequency of not meeting expectations by 0.01. You see here that there is a huge, there is a jump in the distribution. The other motivations, unions, other contracts with customers, suppliers, how to detect earnings management. This is quite hard. I would say almost impossible. Ex ante. Ex post, everyone knows everything. Okay? It's like with Enron case. Oh, of course, it was so obvious. Okay. It was not so obvious 2 years ago when the stock prices were rising. If not, why so many investors were so stupid? So it's almost impossible to detect earnings management. You can guess, but until you are able to demonstrate it, it's quite hard. And again, most of the times, it's not illegal. Okay? So it's very difficult. You have to, again, compare your firm with your peers, compare your firm with the firm in prior years. This is going to be the first step to look for red flags, okay? So analyze financial statement items just to identify the abnormal items. And to identify abnormal, you have to compare. You have to compare financial ratios for your firm and for your peers, but again, you have to be really cautious with that because the accounting numbers that you plug in the formulas have to be of good quality. Okay? And analyze the distribution of earnings chains. Again, comparing T with T minus 1, T minus 2, and blah, blah, blah. How to control earnings management? Auditors. And even with that, it's going to be quite hard. Enron, Arthur Andersen, disappear. Pricewaterhouse was auditing Volkswagen, and it's one of the big four. You should rely on these kind of companies, but they are not so independent. And the quality of the big four, even is supposed to be higher, is not perfect. Restrictions on choices in contracts, but if you put a very tight contract, you don't allow any flexibility to the firm. So this is, again, something quite tricky. Increased regulation, but wow, increased regulation in the banking. They have to meet a lot of regulation already. They will complain. And even with that, global financial crisis was mainly because of banking system. One of the most regulated industries. So it's not a guarantee that it's going to improve or constrain the earnings management, okay? A strong corporate governance, yeah, but what is good and what is bad? Disclosure, how can you control the disclosure quality? I mean, there are ways to constrain earnings management, but any of them is the perfect one. You have to combine all of them together in order to ensure that the quality of the numbers is good. The duration and magnitude of effect, if you do something 1 year, it's not going to be as worst as if you manipulate earnings for 10 consecutive years. And regulation. What are the consequences? They are positive. Again, as I said, earnings management is not always bad. Okay? Sometimes it's good. If I smooth earnings, it's going to be easier to forecast. So I will have less information asymmetry and less adverse selection problem. I will increase my contract efficiency because it's going to be much more easy to detect when the contract is going to be violated. But there are negative sides as well if detected. Qualified audit reports, restatement, investigation, litigation, loss of reputation, higher cost of capital, higher level of regulation, and so on and so forth. But if detected, the first step is to detect. The second step is to quantify. And the third step is just to penalize the firm. Okay? So this is something that you could take a look. It's a real case of fraud, of WorldCom. Okay? It's quite visual and quite interesting if you have time to do it at home. I think that is pretty good just to take home. Like, for your takeaways from the lecture. It's a very good way to summarize the case. So here you have some pitfalls or red flags on where to identify the potential earnings management or potential problems. And this is something that we will go more in depth in weeks 7, 8 because you have the midterm exam, 7, 9, and 10. Okay? So we will go, well, I will not, unfortunately, to each of the parts of the balance sheet and the net income statement to see where is much more common to identify or to find some red flags. For example, the criteria recognition in the asset, if you change the depreciation, and these kind of things, okay? Then you will learn how to identify the red flags, the adjustments that company did, and to go back one step in order to interpret correctly the financial statements. Okay? So it's all for today. Super.